Hello and welcome to this video about investment terminology. If you want to learn about investments, then you're definitely going to hear some of these words on YouTube, the internet, or the TV. So if you want to learn more, then keep watching this video. And also, if you want to like, comment, or subscribe, then that really helps me out. So big thank you for everyone doing that. You're awesome. So I'm going to start off by keeping it super basic with something that you might have heard already. So you may have heard of a broker or a stockbroker. So a broker is basically just a middleman. It's someone who brings you, and so just putting my mic down, it brings you and your investment together. They usually do take a cut of money, and most of the time nowadays they are online services. So something that just makes it easier for you to facilitate your investment, and they will take a small cut because obviously they're middlemen, that's what they do. So another one that you might have heard of is a trader. So a trader is someone who goes in and out very, very quickly. They don't necessarily care about the long term. They're looking at the charts and they're trying to judge the moves of the chart. Maybe they can move in just a matter of seconds, just really quickly buy and sell, and they try to just take smaller chunks over time through that way. Compared to an investor, an investor looks at buying something while it's small and waiting for it to build up over time and then selling for usually hopefully a larger profit over time. And so this goes into our next thing. We want to know our ROI. You'll hear about ROI all the time. It means return on investment. Basically, how much money you're going to get back from your investment. And as we've spoken about traders and investors, we want to talk about the types of analysis. So we already spoke about charts. Well, charts, that is called technical analysis. Being able to understand the movements of the charts, that is technical analysis. Being able to understand the key core concepts of the business, its advantages, what it has going for it, what its weaknesses are, that is called fundamental analysis, or the fundamentals. So obviously you want to be good at both if you can be. Both of them, they do definitely take experience and education, but those are the main two things that you'll hear about all the time. Like, what are the technicals like? Right, the technicals are good, but what are the fundamentals like? So it's technical analysis, fundamental analysis. You definitely need to know those. So yeah, remember that one. So the next one you hear all the time is dividends. So a dividend is basically free money you get for owning something. If you buy a stock that pays a dividend, they're basically giving you free money as a thank you for owning their stock. So maybe it could be every year, it could be every month, every different one's different, but they just give you a small bit of money as a way of saying thank you for investing in us. So that is a dividend. Now moving on to some of the more technical terms. So if you're looking at an investment, you need to know what it's called. And a lot of the time it might not be called by its name. It might be called by a ticker or a ticker symbol. Now this is just a small abbreviation of a few letters that help us to find the thing more quickly. Okay, the next one, this one is super important. You have to understand this. And this is market cap. So what the market cap is it's the total value of the company. And the way we work the value of the company out is by its shares times the share price. So in other things that are not companies, then it's the supply times the share price. So if we have 100 in the supply, 100 shares or 100 barrels of oil, and they're $1 each, then that would mean the market cap is 100 times 1 or $100. So reversing this, if we only have a one of the thing and it costs $100, then again, the market cap is $100. Those two examples, they are worth the exact same amount. Now, a lot of new people, when they first come, they would look at the thing that costs $100 and think, oh, this one is way better. It costs way more. It costs 100, the other only costs 1. But we really need to understand the market cap to get a better idea of the actual size, not just going by the share price. We need to consider the amount of the things that there are. Okay, so also talking about market cap, you'll probably hear the term blue chip. So this one probably sounds kind of weird because you're thinking about eating potato chips or something, but a blue chip, it just means a really, really like strong company, one of the massive companies. They've been around for ages. They're just like the premier companies. So things like Facebook, Amazon, Google, they're considered blue chips. They're just super safe and very, very premium companies. The same with small cap, mid cap, penny stocks. It's basically just, excuse me, probably cut that out. It's basically just a way of deciding how big the company is. If something's a small cap, the market cap is small. It's just as simple as that. So moving on to another super important one is the volume. So the volume is just the buying and selling. If there's a lot of buying and selling, the volume will be high. If there's a little buying and selling, the volume will be low. So the reason we care about the volume is because it tells us how many people are buying and selling this thing. If there's something that hardly anyone is buying and selling, then it's obviously more risky for us to buy because we might not be able to sell at a good price if we have to sell it. If there's only one person that's willing to buy it, for example, maybe the volume's super low, then we won't be able to sell our 1,000 that we've bought. So volume, really important, and a really good way that we can check to see if things are gaining interest. If we can look over time that something's volume is drastically increasing, then we think, hang on, a lot more people are interested in this. So we need to look at this more. Maybe they want to all sell it, or maybe they want to all buy it. We need to check. So the next one you hear is volatility. That just means how much it goes up and down. If something has a very low volatility, it will just move like a straight line. And if something has really high volatility, it will be moving like this. So the way that we calculate volatility is through the beta or beta, depending on how you say that. So things with a very, very high beta, they move around like this, and things with a very, very low beta, they just very, very straight. Okay, so we already talked about fundamental and technical analysis. Once you've done that, you want to know whether you are bearish or bullish. So these go back to animals, obviously, and these are terms you have to know. You hear these all the time. So if you think about it, a bull, it kind of does this and it will throw you up in the air. So a bull market is a market going up. If you are bullish, you think the thing is going up. It's going to make you money. A bear stands on its legs and it crashes down and hits you in the head. So if you are bearish, you think it's going to get hit down. It's going to come downwards. It's going to lose you money. A bear market is a market moving downwards. And again, there's so many ways to talk about making and losing money. There's so many slang terms you might hear. Like in the red, you can see the candlesticks going down, they're red. In the green, the ones going up are green. So if you hear anything relating to these colors, it basically just means the thing's going up or down. The same with things like pumped or crashed. If it got pumped, then it's going up. If it crashed, it's coming down. Another one you might hear is mooned, or it's mooned, it's going to the moon. Now, obviously the moon is really high in the sky, so if it's going to the moon, it's going up loads. Another more technical term for this is parabolic. If something goes parabolic, then it's basically just going straight up. So if you have an investment that just went parabolic, then congratulations, you just made a ton of money. So another one that may be less obvious is long and short. If you think about this, about the way I remember it is how long I want to own the thing. If I think something's really, really good, I want it for a long time. So long means I think it's good, I think it's going up. If I think something's really bad, I want it for a really short amount of time. So no, I'm short, I think it's going down, I want to get rid of it. You can actually short sell. So short selling is when you're betting against the market. You're making a bet that the price is going to go down. And if you're right, then you'll make money. And if you're wrong, if it goes up and you're wrong, then you'll lose money. So we've had a lot of talk about things going up and down. We need to know how we're going to stop ourselves from losing money. Well, one of the ways we're going to stop ourselves is with a stop. So you'll hear people talking about putting a stop on or using stops or a stop. And that just means when the investment gets to this price, sell. So you can put a stop on your investment that, say, if it drops to that point, it just automatically sells. Usually when people are talking about technical analysis, remember the one with the charts, they'll talk about when you do this, then put a stop here. So on the upside, we can make a lot. And if we're wrong, on the downside, we'll only lose a tiny bit because our stop will trigger and it will stop us losing money. So that's a stop. And the next one is margin. So margin is basically just borrowing money. So if you're on margin, then you're borrowing money to invest in things. And if you get a margin call, then that means the person who's lending you the money, they want their money back. So usually if you're on margin, if your thing is doing very badly, then you're losing lots of money, you will get a margin call, and it will sometimes just completely wipe you out. It will basically be them saying, hey, you're not doing very well, pay us all our money back now. So margin is kind of like if you borrowed loads of money and went to a casino. If you don't know what you're doing, you'll put yourself in a really bad situation. But say if you're really, really good at counting cards, or you can see the future or something, then potentially then it can be really good. But I would definitely recommend staying away from borrowing money to do this unless you're an absolute expert. Okay, so next we're going to talk about indexes and some of the markets. So you might hear, in fact, you'll definitely hear the Dow, the NASDAQ, possibly the FTSE, the Nikkei. There's so many of them from all around the world. These are each individual country's different market. So the Dow is short for the Dow Jones Industrial Average. It's from America. NASDAQ is also from America. They have loads in America. FTSE is English. Nikkei is Japanese. And again, like there's too many. Sorry if I miss your countries. So I'm going to talk about the English one because I'm English. So if I buy the index of the FTSE, which is the FTSE 100, then that means I have the average of the top 100 companies in that market. So instead of buying individual ones, I can buy the average, and that is called an index. So these are obviously good because an average, you're less prone to massive swings on the up, but also massive swings on the down. And again, if you think that that market or that place on average is going to do well, then you can just bet on the market as a whole. You can save time. You don't need to go and pick individual things. So again, there's way too many to list, and they all have different numbers. So some of them are the top 100, some of them are the top 500, some of them are the top 225. Each different place has its own different number in the average. It really can be based on just that one. So you really need to check each individual one to see exactly what it's made up of. And I'm going to leave you with two that you'll definitely hear of if you watch a lot of YouTube. A lot of American YouTubers really recommend these, and that's because they are American. They are the 401k and the Roth IRA. So these are retirement saving plans. They're ways you can make some tax-free money, and oftentimes your employer will also pay into them. Again, American YouTubers, they do recommend these a lot. That's because I believe you need to be based in America to actually access them. So if you ever hear those terms, that's what they're referring to. They're referring to essentially saving plans for Americans. So I hope you like this video, and thank you, and bye-bye.